If you want to be a better investor, better at picking the best businesses to own, you must become better at reading a balance sheet. Accounting is the language of business, as Warren Buffett puts it, and the balance sheet is their written word. Imagine going to a foreign country and not being able to read any of the signs and being totally useless trying to find your way around town. Well, that's how most people are when trying to read a balance sheet. And just like you don't want to end up in that bad part of town, you don't want to lose money in a terrible stock. Welcome to The Quality Investor. In this video, we're decoding the balance sheet. We're starting with the current assets. What does each of those line items mean? And what are the measures to know to separate that high quality business, that business with a super wide economic moat, from the rest of the very average pack? Please, if you haven't already, hit that like button and we'll continue on with the rest of the video. Before getting into the specifics of the current assets, what does the balance sheet actually tell us? The balance sheet is a snapshot in time. Each item is a specific amount on a specific day. Using cash as an example, it's how much cash is in a bank account on the day of reporting. Usually on the last day of the month, and usually every 3 months or once a quarter. Typically, we say that the balance sheet has two sides: the assets, today's topic, and the liabilities and equities. Each of these sides must equal each other. In other words, be in balance. The equation is simple. Assets equals liabilities plus equity. So, what is an asset? On my first day of accounting class in college, I actually majored in accounting. I learned that an asset is any item that provides a future economic benefit. Therefore, anything that is booked on the asset side of the balance sheet, the business believes it will provide some benefit to the business in the future. So let's take a look at a balance sheet. This is applied materials. Notice the order of each of these line items. Every business will list cash first. This is followed typically by short-term investments. Sometimes you'll see these lumped together. Next, we have accounts receivable. In this case, net. Net means it is net of allowance for doubtful accounts. When you have a bunch of invoices outstanding, a business won't necessarily collect all of those invoices. So they create something called allowance for doubtful accounts to account for the fact that some of their vendors won't pay them. They deduct that against accounts receivable, and that's where you get net. Followed by inventory, then prepaid or other current assets, then the non-current assets like long-term investments, property, plant, and equipment, and so on. The point here is that these are ordered by liquidity. Cash being the most liquid, accounts receivable, sales, made but not cash collected, the second most liquid, inventory, goods a business is selling, third most liquid, and so on. So the closer an asset line is to the top, the closer it is to becoming cash. Assets are further classified into current assets and the non-current assets. A current asset is anything a business expects a realized economic benefit from within 1 year. Businesses expect to collect receivables within 30 days. Short-term investments typically mature within 3 months. Of course, businesses are always trying to move inventory as fast as possible. A non-current asset is anything the business expects a realized economic benefit from after more than 1 year. The machine used to build that inventory, they expect to use that for years. The truck used for shipping, again, they want to drive it for a very long time. They can always sell that truck later, but not for the price that they bought it at. That's a different discussion, which can be covered in a different video, so stay tuned. Our focus today, though, is on current assets. How do we assess each of these to know that a business has a competitive advantage? The best investment gains are made in businesses with a strong economic moat, a durable competitive advantage. And that's what we're trying to decode today. Before getting to the real meat of the current assets, let's talk about prepaid expenses and other current assets. Other current assets are typically items due to a business within 1 year, but not yet in their hands. Very often, they're not part of the normal operations of a business, so they have a very much one-time quality to them. Deferred tax assets are an example here. Imagine selling an investment for a loss. you can actually take that loss and deduct it against any future taxes that you might have to pay. That future deduction is an asset. Prepaid expenses are items that are prepaid, and an expense is equally deducted from that asset each accounting period, usually in a 1-month increment. An example of this is insurance. Auto insurance is prepaid 6 months in advance. So each month, the business takes 1/6 of that insurance policy and deducts it from the prepaid amount. Prepaid and other assets give no real insight into the economic moat of a business, so I won't really go into them any further. Let's start with cash and cash equivalents and short-term investments. I usually lump these two together as cash when I'm doing my calculations. Cash is, well, exactly what it says it is, cash. And short-term investments are usually converted to cash very quickly, typically within 3 months. Short-term investments can range from money market funds, CDs, government bonds, commercial paper, even short-term mutual funds. And many times you're going to see another item with very cash-like qualities called marketable securities. The difference here is they're bought and sold on public stock and bond exchanges. These are effectively stock in other companies, and they're separate from cash due to their accounting treatment. That treatment is marked to market or valued at the current market price. They're also considered current if the business plans to sell them within 1 year. This is the file I built to use when I'm analyzing all the current assets. The first thing this shows me is a breakdown of all the assets. So I can see my cash and equivalents, my short-term investments, and then percentage of their assets. I'm also looking at a couple other KPIs: accounts receivable days outstanding, inventory days outstanding. Each of these indicate how many days it takes to either turn their inventory over or collect accounts receivables. You can see here for Apple that at their latest period, it took them 58 days to collect accounts receivables, which is a little bit above their average of 53 days. This is the min and the max. Their inventory, it's actually taking them a little bit longer to sell all their inventory now, 9.6 days. Their average here is 8.5 days. You want to see this to be below that average. And then a few other KPIs like current ratio, quick ratio, debt to equity, and working capital. Current ratio is basically current assets over current liabilities. In Apple's case, that's essentially 99 cents of current assets versus current liabilities. Then the quick ratio is cash plus accounts receivables over current liabilities. In this case, it's 84 cents of those over current liabilities. Debt to equity, which is debt to equity, and then working capital, which is current assets minus current liabilities. Right now, Apple has a negative $2 billion in working capital. Ideally, you want to see your current and quick ratios above 1 and your debt to equity below 1. However, there are certain instances where these may not be as big an issue as we're going to see here in a second. Let's talk about cash and how we can identify if the business has a wide economic moat. Cash comes from a number of sources. There's operating cash, stock issuance, debt issuance, net investment sales, which could be the short-term investments I showed you or the long-term investments they have on the balance sheet, and divestitures, which is typically getting rid of businesses that they might own. So we're looking here at Apple, and what I'm looking for is what is the dominant source of that cash? You can see Apple here, a lot of green bars, which means their dominant source of cash is operating cash. In fact, on a trailing 12 basis, they collected $116 billion in operating cash alone. What I'm trying to do is compare that to this debt issue, this blue bar. You see, this I don't want to see nearly as high as operating cash, because of what that means to me is the business is funding its operations on an ongoing basis with cash organically or generating from typical business operations. This gives me an idea here on this second chart, the cash versus debt, how serious their debt issue might be. One sign of a great business is their cash is higher than total debt. They have a net positive cash balance. However, if you see up here that they're generating a lot of operating cash and they're not taking out that much debt, then an instance like this, where cash is less than the total debt, isn't as much of a red flag. Here is an example of red flags when you're looking at your cash sources. This is Walgreens Boots Alliance. Notice how the blue is much higher than the green, especially after around 2015. And you can see that reflected down here on the cash versus debt. The cash has steadily been decreasing, while that debt, while decreasing, is much, much higher. The real issue here is the decline in operating cash while the debt really is not declining. That's a red flag to me because that's going to make it hard for Walgreens to cover their debt payments if their operating cash does not recover. So we want to see healthy growth in that operating cash and debt issuances not that far above, ideally below. Let's look at accounts receivable. Accounts receivable is an invoice for a good or a service to a vendor or another party for which that good or service has already been provided. For example, if a factory sends goods to Walmart, that factory sends Walmart a bill. The factory may even give Walmart 30 days to pay that bill. And until Walmart pays that bill, that invoice sits in the factory's books as an account receivable. And once the factory receives that cash, it's moved out of accounts receivable and into cash. The idea here is that each non-cash asset will at some point move into cash or be used in some way that provides revenue to the business that will later become cash. All businesses want to keep that cash flowing. All right, so what am I looking for account receivables? Well, this is Adobe, and I'm looking at the account receivable margin percent. This is accounts receivable divided by total revenue. What we want to see here are a couple things. You want to see this trending downwards over time. This indicates that they're collecting their accounts receivables faster. The reason this is very good is that you want that accounts receivable becomes cash as fast as possible because then you can start doing something with that cash, start earning money in other ways by investing that cash. Also, it's good to compare this with other businesses in the same industry. You want to see an accounts receivable margin for the particular business you're looking to invest in lower than its competitors. So Adobe right now is below 12%, for example. Contrast that here with Microsoft, which right now they're sitting at 22.98% in their last fiscal year, and on a trailing 12 basis at just over 18%. Next is inventory. Inventory is any goods a business has for sale to customers. Using Walmart again, every item that you see on their shelves is inventory. You give Walmart cash, you get an item of Walmart's inventory. Sometimes you'll be looking at a business that manufactures goods to sell. In this case, inventory is breaking into three parts. These are raw materials, which are the basic materials required to start the manufacturing process, works in process, which are items in the middle of the manufacturing process, and finished goods, which are manufactured goods waiting to be sold. When you're assessing inventory, there's a couple things to look at. This is applied materials. First thing you want to look at is inventory versus revenue. You want to see that inventory increasing along with revenue, and ideally decreasing when revenue decreases. That's telling you the business does a very good job of managing their inventory. Right now, applied materials is actually at 150 days of inventory outstanding, which is actually kind of typical in the semiconductor industry right now. All of them are having issues due to the semiconductor mini recession. You also want to look at inventory turnover and inventory to revenue. This blue area here, you actually want to see this increasing. What this is telling you that over time, applied materials has actually done a worse job getting their inventory out the door. And then for inventory to sales, however, you do want to see this to be very low or lowering. And right now they're sitting at 0.21, which is actually pretty good. Anything under 0.25 for inventory to revenue is pretty good for the business. What you don't want to see is something like this. This is Biogen. The first thing to look at here is your inventory is going up, but your revenue's declining. This means they're not selling what they have on hand right now. And then the inventory to revenue is another indicator of this. It's pretty flat. And then suddenly, since 2020, it's shot up. Whereas inventory turnover has gone the opposite direction. So basically, Biogen's having issues with getting their inventory out the door. So all in all, these are the basic measures that you want to take a look at when you're assessing the current assets. Where's their cash coming from? How does it compare to debt? Is their accounts receivables margin going down? And are they managing their inventory well? Businesses that do an excellent job in all of these areas are definitely businesses with wide economic moats. Make sure to subscribe to my channel though to check out all the other videos I have talking about identifying businesses with wide economic moats.